Okay, I am back and live. I do apologize that we had a little bit of a technical issue. Wasn't able to totally fix it, but I'm going to do my best and just get the training going today. So hopefully you guys can see this okay. Definitely let me know in the comments if you have any problems hearing this or seeing this. But you got to love when you're doing live training and you're dealing with, you know, you're dealing with technology. It just is what it is. So let's see here. Okay, it looks like I can see it, so I hope on your end that you can see it okay. So we're going to get into our training today on long-term care insurance. I do apologize again for the technical glitch, but this is really, really important information, and in all honesty, not everybody needs long-term care insurance, but most people do. So we're going to talk about today some things to know about, and then also some questions to ask when you're going to search for your policy, okay? Oh man. Let's try this out. Okay, so hopefully you can see this okay. I know it's a little bit small. It's in preview mode, but it's not working the way I want it to. So I do apologize about that, but let's get this going. So in the simplest terms, long-term care insurance is a way to directly pay for long-term care expenses while at the same time transferring this uncertain risk to an insurance company. So just like any other insurance, when you buy insurance, the whole goal with that is you're going to be paying a premium so that you can transfer the risk of whatever catastrophe you're trying to avoid to the insurance company, and for that you pay a monthly or annual premium to the insurance company to insure against that. Their whole goal is to collect premiums from a big group of people, and then make a profit after paying out what they need to pay, and then paying out whatever insurance claims they need to pay to the public, and then anything left over they get to keep. So that's the whole goal with insurance. Most people do purchase a long-term care insurance policy when they're young and healthy, with the expectation that when they need care later in life, the benefits will be available to help pay for it. Also, the younger you purchase, the lower amount of medical requirements you have to go through to get a policy in place. So the average age people purchase their long-term care insurance policy is 57. If you're going to buy before 60, it's definitely a lower cost, but the reason for that is because there's a lower likelihood that you will actually use that policy as well. So, if you try to purchase after 65, it's going to get quite a bit expensive. So usually somewhere in the middle there, if you are looking at purchasing a long-term care insurance policy, somewhere in that range is going to be probably the best area for you. If you try to purchase after 70, it's going to be really expensive, so just keep that in mind. I definitely recommend purchasing a little bit on the earlier side if you are going to purchase a policy. So long-term care insurance usually either pays for the actual expenses incurred, so that's usually with a daily financial cap, or it pays the insured a daily benefit amount, regardless of the actual expenses incurred. So in either case, there may be a lifetime cap on the benefits. Now, some policies may offer a pooled benefit, so for example, $250,000, often with a daily benefit cap. Paying for actual expenses is generally safer for the insured, but a majority of policies seem to be of the daily benefit, as in not reimbursing for expenses variety. So these are things you're going to have to look through as you're going to purchase your policy, and you want to make sure that you're aware of how it works. So why is one method safer than the other? It really has to do with the taxation of benefits. So the tax code generally makes benefits that pay directly for long-term care expenses tax-free, very similar to health insurance. So just as if you pay for health insurance, you get you pay for it pretty much tax-free, and it's the same way with long-term care expenses. So just as we do not pay taxes on the benefits when our health insurance provider pays the doctor, we do not pay taxes when our long-term care insurance policy pays the nursing home bill. So this makes it easy to determine the taxability of benefits, essentially no taxation. The daily benefit or per diem plan presents a different taxability situation. So here, the taxation of benefits depends on whether those benefits are less than or greater than the tax-free amount set by Congress. So their amount is generally indexed annually for inflation, but the 2018 tax-free benefit is $360 per day, and that's the same as it was in 2017. So what this means is that any amounts received by the insured up to $360 per day will be non-taxable. Amounts over $360 will normally be taxable unless actual expenses exceed that amount. So here's the most important part of this training. So you definitely want to get a pen and paper to write these down, or go back through this training because these are the questions at minimum you should be asking when you're evaluating a long-term care insurance policy, okay? So really, really important. So make sure you're writing this stuff down, or that you spend time later to go back through this training and get all these questions down when you go shopping for your policy, okay? So first question you want to know is, what levels of care are covered by the policy? Is it skilled care? Is it custodial care? What levels of care are going to be covered by the policy that you're looking to purchase? So the more levels of care that are covered, most likely the more expensive it may be. Second question, where can you receive benefits under the policy? Is it at any licensed facility? So what if you move state to state, in your retirement time? You live half the year in one state and half the year in another state. Can you go to any licensed facility, or do you have to go to a specific facility that's covered under this particular policy? Does the policy provide home care benefits? And if so, at what % of the daily benefit? Okay, so some folks just want home care. That's okay. You want to make sure that it actually covers that. That's really important to ask, because some policies do, some don't. Are homemaker services covered, and how? Can personal care be given by home health aides? Really important question. Does the policy pay for care in alternative settings, such as adult daycare or assisted living? So in the training from last week, we did talk about, adult daycare, which is somewhere where folks can go that if you're still active, but you need some general assistance, it's a really, really good place to be to keep your mind active and keep your body moving and do different things. But you want to see if your policy will pay for care in these quote unquote alternative settings, all right? Not just a full-on long-term care facility setting. Okay, next question. How much will the policy pay per day for home care? This is a really important question, because you'll see a big range on this. And again, buying a policy, you want to make sure it's within your budget, but you also want to make sure that you get enough care so that you're not being drained from your assets if you do need to use the policy. So how much will the policy pay per day for home care? How much per day for assisted living care, adult daycare, Alzheimer's facilities? You want to know what the policy is going to pay per day for each of these types of care, okay? Then you also want to know, what is the length of benefit period you are considering? A lot of policies will go for, say, 2 to 3 years. That's the average stay, and that's going to be good for the majority of folks. But as we experienced recently in my family, my grandfather recently passed away about a month ago now at 97. He had assisted care for about 13 years, right? So some of these policies will run out if you don't check the fine print and make sure that you have, the benefit period that you're really looking at. So take a look at it. 2 to 3 years is going to be good for most people. But what if there's a catastrophic situation where you need, 5 or 10 years of care? Do you have something in there that's not going to, drain all your assets if that happens? Next question. What are the benefit triggers of this policy? So what are the things that are going to trigger, when you actually will qualify for the long-term care policy to kick in? Another big question, when do benefits start? Some policies, the benefits will start after 3 months. Some will start after 6 months. Some may not start up till even up to 12 months. And so during that time, you would be paying care out of your pocket. So you really want to make sure that you know when your benefits start, and you plan for that period, okay? Are there waiting periods for home care? Are the waiting periods for home care cumulative or consecutive, right? So sometimes you have to be, you're going to have like a 2 month or 3 month window. Is that cumulative, in all time, or is that just going to be, consecutive, back to back? So you really want to look at that when it comes to your policy. Here's another big one. What inflation protection is available? Most policies are going to come with some sort of inflation rider. You want to double check that. Somewhere around 3 to 5% is usually good, and that's pretty common. But if you look at your policy and there's no inflation protection available, that's actually a little bit scary, because at the end of the day, you're buying this policy now. You may be in your late 50s or early 60s. You may not use it for 20 years. And if you have no inflation protection built into your policy, that could be a very risky thing to consider long term when you're looking at what the cost of coverage is going to be in that time period. It's going to go up significantly over that time. So you want to be aware of that. And what are the benefit? Oh, I guess I wrote that one twice. Sorry about that. What are benefit triggers of this policy? I guess I wrote a bunch of these questions twice. Okay. So the next question that actually is applicable is, are you allowed to buy more coverage? When and how much? A lot of policies will not allow you to buy more coverage, but if you are, you want to know what the guidelines are for that particular aspect of the policy. Is there a waiver of premium benefit, and when does this go into effect? Okay, you really want to know that. Is a policy tax qualified? Important question. Here's a good one for married folks. Is there a discount for couples if both buy policies? And is there a joint policy available? So you may want to look at buying a joint policy versus buying two separate policies. If you're a big gap in age range, between you and your spouse, say 10 or 15 years, you may want to look at separate policies because, obviously one is more likely to need long-term care before the other. So, you really want to look at all the options when it comes to when you're shopping and make sure you're getting the best overall value for your dollars. And the big question is the policy premium within your budget? Really, really important that you really buy a policy premium, when you buy a policy, you want to make sure the premium is within your budget. The worst thing you could do is pay for a policy for 15 years and then at one point not be able to pay for it anymore when you really need it, and now you have no coverage, right? What we're seeing now recently in the last year or two is that there's huge jumps. Like many policies had no increase at all for 10 years, and now they're increasing 40, 50, or 60% in 1 year. So for folks that are on a very strict, just a very strict flat income, that's going to be a problem. Like if you only have $5,000 a month to live off of, and you're used to paying $300 or $400 a month for your long-term care insurance policy, and now it goes to $800. If you're on a fixed income, that's really, really going to hurt your budget on a monthly basis. So really important that you make sure the premium is within your budget. And then I also would recommend that you definitely make sure there's room, that if that policy were to increase over time, that you had to pay more, then you would still be able to afford it, even if your budget stayed the same or your income stayed the same over the long period of time. Okay, so this was just a quick intro. I want to do a quick training today since I just got back into town. But we'll be going over some more trainings in depth over these next few weeks over long-term care and then other things when it comes to Medicare and retirement. If you would like help with your long-term care insurance planning or really any retirement planning subjects, I do offer complimentary consultations for folks here in this group that if you want to take advantage of it, it's 45 minutes that I can do my best to help you create a retirement strategy that is going to suit you for these next 10, 20, 30, or even 40 years in retirement that many of you will be enjoying. If you would like to schedule a call with me, you can go to kisplanning.com/apply. And all you have to do is schedule an appointment that makes sense to your schedule there. There'll be a few questions for you to answer so that we can utilize our time together. And then we'll spend about 45 minutes to an hour. Hopefully it's the best time you spent on your retirement planning, and we'll create a strategy for you so that you know what to do before you make that move into retirement so that you can retire with confidence. So in the last few minutes here, I'm going to stay on and answer any questions that you all may have. So if you have any questions at all, go ahead and drop those in the comments, and I'll do my best to answer them, okay? Let's see here. Okay, so looks like folks could hear us. Okay, that's good. Is there any questions about long-term care that you'd like me to answer for you while we are on this training? And if not, that's okay. I'll hop in a little bit later to answer questions for you. The biggest question I get is really, should I get long-term care insurance, right? Let's take a scenario where you maybe have some assets saved, but maybe it's not, $10 million, right? Maybe you have, say, $300,000 saved, and maybe you have Social Security that covers your basic expenses, and beyond that, you're gonna have to draw on assets to pay for, anything additional beyond, basic living expenses. So what would I do in that type of situation? Typically, if you either have a lot of money, so you're maybe in the $3, $4, $5 million category of assets, or if you have very little money saved, where you're going to pretty easily qualify for something like Medicaid, then that's where you probably don't want to get a long-term care insurance policy, because either you can't afford it on the low end, or on the high end you can self-insure, so it's not a big deal, right? So if you can self-insure, you don't have to worry about it too much. On those extremes, probably not. You probably don't necessarily need a long-term care insurance policy. But if you're somewhere in the middle, and maybe you have $3, $4, $5, $6, $700,000 in assets, well, what's going to happen if you have to all of a sudden start paying $100,000 per year for care, right? For yourself or for your spouse? How long is it going to take for you to burn through your assets? That's something you really want to look at. Because if you have to pay $100,000 a year and you have $300,000 in assets, you have 3 years to cover yourself, and then you end up with no money, right? So it's a really tough question. So in general, most folks, the answer is yes, you should probably get some sort of long-term care insurance policy. The amount of coverage is going to be the variable factor. So what I mean by that is you can get different levels of daily coverage or per diem coverage depending on how much you want to spend on an insurance policy. So if you want to be on the low end, a lot of times you can maybe get $150 or $200 per day coverage. And if you're buying it young, say about 60 years old, what I'm seeing is somewhere between $2,500 and $4,000 a year to have that coverage. But if you look at how much you're going to have to pay for when you'll break even, it's probably just really a couple years of long-term care coverage. You're going to break even if you have to pay for 20 years, right? So in general, it does make sense for most people, but it is a 50-50 shot. I'm seeing way too many people listening to their friends, and their friends are all wanting to take a risk that they won't need long-term care. And so there's this huge movement of people just willing to take the risk. I would advise against that, okay? I would highly advise against taking the risk of having no plan at all for long-term care, or just hoping that you don't need it. Not a good strategy. But if if you're looking at, do I take one extra vacation a year, or do I pay for long-term care insurance? I would advise you to get something in place to take care of yourself, because with the medical advances that are happening now and that are coming, the chances of us living to 100 years old and beyond are getting much, much higher every single year. So unless you have health issues of some sort, then, and you're going to pass away early because you're already on a time clock, there's a very good chance you're going to need some sort of care. Like I said, 70% of people do utilize some sort of long-term care. 50% go to a facility. So, I would advise you to look into this, okay? So if there's no questions, I don't see anything coming up here, I am going to log off until next week. Oh, okay, here's a good question. Oh, wow, I don't know where I have 10 questions. Okay, this is good. Let me turn this down. Okay, let's go through some questions here. Good. So Karen asked, do I recommend a combo life insurance long-term care insurance policy? So these are what are called hybrid policies, okay? So these hybrid policies, let me go back to my other screen so you can see me here. Let's go back to this screen here. Okay, great. So Karen asked the question, do I recommend the combo life insurance and long-term care insurance policy? So these are what are called hybrid policies, okay? So that's essentially where you invest some sort of lump sum. Usually it's at least $50,000 to $100,000 that you put in as a lump sum. And it's essentially a whole life insurance policy. It operates very similar, and it's expensive in a sense in the same way, where if you pass away, you get the death benefit. But if you need long-term care, then you'll have a certain amount of long-term care built into the policy that will take care of you for whatever period that is defined in that particular policy. So these policies are, on average, you're going to pay about 2 to 3 times as much for them when it comes to getting your long-term care covered. But you have the benefit of getting the death benefit when, if you never use it. So you're essentially saying, okay, do I want to pay 2 to 3 times more for my long-term care insurance? Or do I want to take the 50-50 shot that I pay less, but then I never use it, right? So that's really what you're evaluating when it comes to these policies. I think they have their benefits, but like I said, you're going to pay 2 to 3 times as much for your long-term care insurance overall. So, that's how I look at it. How do you want to pay for it essentially? So let's see. Brenda said, we recently started long-term care insurance also at age 54 and 56. Very affordable. That's good, Brenda. I'd love for you, if you don't mind, Brenda, if you want to share what you're paying at 54 and 56, it's probably a lot cheaper at 54. That's a pretty early time to buy it. but you are going to pay for those extra years, right? Between 54 and say 60 or whatever it may be when you want to buy it. But yeah, once you hit 60, the policies definitely take a jump, and then 65, they take another jump. At 70, they take a huge jump. So buying early is usually the better strategy. But when she says very affordable, I'd love to know what that means by her. Let's see. Brian, some plans, the partnership plans, shield assets by the dollar amount of coverage becoming the spend down threshold to qualify for Medicaid. Is this asset protection worth it? So with any of those type of things, you're going to have a look back period, and it depends, right? It's if you want to protect your assets so that they don't get taken and then you can qualify for Medicaid, essentially, you are going to be getting the government level of coverage when it comes to your long-term care coverage. So that's going to depend, state to state, even probably county to county. What is the quality of that government level of coverage, when it comes to Medicaid? Because some are very bad, really, really, really bad conditions. And so you're protecting your assets from being used, but then you're going to live some of these last years of your life with, maybe subpar, quality of care. I don't know. I'd have to really know a lot more about the particular situation with that, but I know that is something people try to do when it comes to, protecting their assets from the use of long-term care. Brenda shared $233 a month. Is that for a joint policy? Because that's a really, really good price, and that's very affordable. So if that's for a joint policy, so for as little as $233 a month, you can have some sort of long-term care coverage. That's very, very reasonable. You probably have pretty good health, Brenda, I would assume at that age. But, that works out to what? About $2,800 a year or so. Definitely worth spending $2,800 a year, in my opinion, if you can budget it out so that you have this coverage taken care of for yourself long-term. So really, really, really important. Okay. Yeah, Karen says, don't do that in California. Medicaid facilities are terrible. I'm in California here. I've heard horror stories. Absolutely. But again, we have people here in every state. So there's some state facilities that are very nice and that are very good, So definitely want to make sure before you make that decision to try to shield all your assets and hide them so that you can qualify for Medicaid, that you're not going to set yourself up in a position where now the government care is horrible and you're living this life that's just really just not, pleasurable at all, right? That's not the idea. The whole point of having assets is to be able to take care of yourself and to provide yourself good care, and good level of coverage when it comes to this time. Because in all honesty, if you're in a long-term care facility, there's a very good chance that you've lost some of your abilities, whether it's, cognitive, whether it's physical, could be, a lot of different things. So if you're going to go into a facility, you want to make sure that you're getting something good. I mean, if you have $300,000 or $400,000 of assets, I think it's worth it for you to invest in a good policy, because these times can be very tough and very stressful, right? So I want you to make sure that you're covered. And Brenda said, yeah, that's for both of us. So for a couple to get it for $233, great deal. That's a great price. So as long as it's a good policy, Brenda, I would encourage you to go back through and go through the questions that I went over today and make sure you know the answers to all those different things, because that's actually pretty low. The $233 a month, that's a pretty good price. So if you have good coverage and it's a reasonable period where you have to wait for the policy to kick in, then that's wonderful. Really, really wonderful. So let's see, what other questions we have on here? So Carol asks, how do you determine if you can afford it? Well, let's be honest. Are you, like, if you were going to buy a policy, right? Let's say you were still working, okay, and you were going to buy a policy. And let's say you wanted to retire. Let's say you're 60 years old, you're looking to buy a policy, and let's say it's at $230 or whatever it may be. Well, when you're working, let's say you can afford it very comfortably, not a big deal. But what if you wanted to retire at, say, 63, and you're retiring a little bit early, and now you're going to lose your income, and you listen to what Jason says, and that you are going to delay taking Social Security so that you can qualify for some more credits. You don't take it right away at 63, and now you have to cover your expenses somehow, either from your assets or from part-time work or whatever it may be, from, say, 63 to 67 while you are delaying so that you can qualify for full retirement age. Well, does that $230 a month, does that significantly impact your budget? Does that require you to not enjoy life and to really not do anything except eat at home if you were to cover that? Then no, it's probably not a good idea, right? you should probably work another year or two so that you can make sure you can cover that without an issue. But when it comes to percentage of income, $230 to maybe $600 for like the top-notch policy. I've seen a little bit higher, but that's a general range. I don't really look at that as a percentage of income necessarily because I don't think that's a good way to do it. But if you were to take all of your guaranteed sources of income, for example, in retirement, say you had Social Security, say you had a pension, and say you were going to draw a reasonable amount off your assets. Well, if that $233 a month made it very stressful, like say, for example, you had to earn a high interest rate on your investment so that you can cover your expenses, then that's probably pretty risky, right? So not a good thing. But if you have a solid pension, you have Social Security, you don't necessarily need it because your pension's so good and you have a good amount of assets, then definitely you want to invest in a policy to make sure that you're covered. Even if it's a 50-50 chance, as I mentioned, it's the most underinsured area in the United States right now, long-term care. So most likely the answer is going to be yes, that you should invest in that. So let's see what other questions that we have. I see Brian wrote that he bought his policy at 55 years old, but still relatively healthy. Brian, if you wouldn't mind sharing what you're paying today, if there's been any jumps since you have invested in that policy, I'd love to hear about that. But any other questions that I can answer for you all today? As you guys know, I'm a fee-only financial planner. I don't sell insurance. I have no incentive to tell you to buy long-term care insurance besides me wanting you to protect yourself. I don't make any commissions. That's not how I operate. So I'm doing this so that you can do the right thing for yourself and get the good information that matches up with what your long-term goals are. So I'm not seeing any other questions come through. So we will wrap up for today. Thank you all so much for showing up for the training and asking good questions. Really, really good questions today. Long-term care insurance is really important. We're going to go a few more levels deep on long-term care insurance and then also Medicare over these next few weeks. As I mentioned, I will be doing some traveling over these next few weeks. My brother is getting married, and so I'll be out in Texas for a weekend, and I'll be up in northern LA for a weekend. So I may or may not be able to do these trainings live, but I will upload something for you to continue to build on your knowledge, okay? Appreciate you guys so much. Again, once again, my name is Jason J. Hamilton, and if you need anything at all, go to kisplanning.com/apply, and I'll help you really get through any details or any questions that you have about long-term care insurance or anything when it comes to retirement planning. And other than that, enjoy your weekend, have a great day, and we'll see you soon. All right, bye-bye.